Guess what commercial model travel agencies follow? Agencies operate on the agency model. Today, more and more travel resellers take another approach, one that gives them more control over payments. They shift to the merchant model. Let's see why. It all began with one man in a small office space in Amsterdam, the Netherlands. So begins the story of Booking.com, one of the largest travel marketplaces to date. In 1996, recent university graduate Geert-Jan Bruinsma built a hotel booking website that grew from one reservation a week to about 1.5 million a day. Booking.com became an example of how technology disrupted the way people buy travel. But at its core, the innovative online platform didn't differ much from its brick-and-mortar counterparts of the pre-internet era. It earned money and became a dominant player in the European OTA market using the good old agency model. Operating on the agency model basically means that your business acts as a storefront for somebody else's products. In travel, agents showcase flights, accommodations, cruises, whatever. Agents help choose and book vacations and business trips. How does this approach look in practice? Suppose a traveler books a flight and hotel stay with a traditional OTA. He or she enters their credit card info into the payment form on the OTA website. What happens next? The agency passes this data to the airline and the hotel, which act as merchants of record and actually withdraw money from the card. The OTA typically receives its commissions weeks or even months after services are delivered. Despite delays, the agency model still offers a lot of perks to OTAs and TMCs.
The main advantage of that is that it reduces the liability for the travel agency. So they don't have to have a deposit because it's actually the airline or the supplier in general. That's the merchant of record. So they're not part of the money flow and they're not part of the liability in case the supplier in the end doesn't deliver the service, doesn't honor the ticket or the hotel booking.
Paul van Alphen is a travel payment strategist and managing director at Up in the Air, a travel payment consultancy. Another benefit of the agency model is that the investment into tech infrastructure is relatively low, as long as agencies pass sensitive financial information without storing it. Also, while they still must comply with the Payment Card Industry Data Security Standards, or PCI DSS, the requirements will be minimal. Watch our video on PCI DSS compliance to understand why it's important for travel agencies. However, avoiding complexities has its consequences. Under the agency model, an OTA or TMC can't change prices set by suppliers, nor can it accept forms of payment other than cards, individual for leisure travel or corporate for business bookings. The only way to lift those restrictions is to move to a merchant model. While Mr. Bruinsma was securing his first commission-based reservations for Booking.com, on the other side of the Atlantic, two co-founders of another booking website, now known as Hotels.com, were pioneering a novel approach, the merchant model. It took David Lippman and Robert Diener quite some time to persuade the first hotels to accept the new rules of the game. Soon, the merchant model became the driving force of another world's largest OTA, Expedia, currently predominant in the US. Hotels.com today also belongs to the Expedia group. What was so revolutionary about the merchant model? It gave an agency control over prices and money, removing the dependency on commissions. Under this framework, a reseller negotiates net rates with suppliers, forms the final offerings by adding markups or applying discounts, and bundles products, something hardly possible in the agency model. Also, the merchant manages the end-to-end payment flow, which has two legs: pay in from an end consumer and pay out to individual suppliers. The pay in could be a credit or debit card, a buy now, pay later option, a mobile wallet, or any other form, given that the agency's tech infrastructure supports a particular method. The payout, in turn, may rely on bank transfers, virtual credit cards, BSP Cash, or Arc Cash, depending on the supplier. Since the two stages are totally decoupled, this gives agencies a lot of flexibility.
They can take a payment now and pay the supplier later. They can take a payment in one currency and pay the supplier in a different currency, one amount, different amount. So they are very flexible, and they can also bundle, right? So they can, if you make a booking, and the booking is basically a basket of multiple, a flight, a hotel, a car rental, an insurance, they can take a single payment from the end customer, and then in the background pay the individual suppliers by different forms of payment at different moments in time.
For example, a Toronto tourist wants to buy a trip from New York to Paris with a 2-day hotel stay. The US-based OTA creates a package from the net flight and hotel rates and applies a markup so that the bundle will still be a bargain for the traveler. The happy tourist pays with PayPal in Canadian dollars. The agency pays for the flight in US dollars using Airline Reporting Corporation. Only after the guest's check-in does the reseller issue a virtual credit card to pay in euros to a French hotel chain. The scenario leaves much room to leverage margins, upsell and cross-sell products, and build strong customer relationships. Yet, as usual, there are pitfalls to be aware of.
With great power comes great responsibility.
No matter who actually coined the phrase, Voltaire, Winston Churchill, or Spider-Man's uncle, it still perfectly describes the shift to the merchant model.
Going and shifting towards the merchants of record enable a much better agility in terms of the product distribution, the direct management of the relationship with the travelers, the loyalty reward programs, and everything that you can essentially sort of build around having the direct ownership and the direct accountability in the relationship. And there's also a little bit more opportunity in terms of exploring, expanding beyond geographies, beyond markets. But it is not to say that it is necessarily a seamless approach, right?
Sandra Mianda is a payment strategist and a founder of the payments consultancy, Papered Work.
It's not necessarily a model that every single agency would flip to, right? Because it comes with some sort of due diligence and assessment in terms of the operating model, in terms of the resources, in terms of the cost implication to be able to fully branch into a merchant of record model.
A merchant of record must set up a merchant account, integrate with a payment gateway, and take on liability for taxes, chargebacks, refunds, fraudulent transactions, and many other things. It has to implement and support various payment flows instead of just forwarding card data to suppliers, as with the agency model. And of course, it must maintain a secure infrastructure to comply with PCI DSS. All these imply significant operational risks and overheads, additional investments, and important decisions to be made. The first crucial decision concerns payment service providers, or PSPs, to enable online transactions. Payment service providers are financial companies that connect merchants to card networks. They offer two key components of the pay-in stage: a payment gateway and a merchant account. A payment gateway is a digital service that ensures a secure data transition between parties involved in processing electronic transactions. A merchant account is tied to the gateway and allows for the 24/7 acceptance of electronic payments. It holds funds while the transaction undergoes checks and reconciliation before being transferred to the main business account. To launch this special account, an agency must partner with an acquiring bank that facilitates electronic transactions. Since travel is often classified as a high-risk business due to frequent chargebacks, high levels of fraud, and vulnerability to external factors like epidemics, economic instability, or bad weather, the associated merchant services come with higher fees and more restrictions. The opening of the account may take longer because of the strict due diligence procedures. At the end of the day, the application can be declined if the travel agency is new, small, or lacks robustness.
Whilst travel has always been an high-risk industry, post and during COVID, it's literally catapulted the risk level and the risk appetite to all-time high. What that meant is that your traditional supplier from a payment perspective have been increasingly more conservative in terms of onboarding travel merchants, and they would tend to potentially only focus on your top big players, right? So if you're a big agency, yes, you would potentially have a much better chance to have some interesting and not deterring term with a payment travel supplier.
Suppose your business is well enough established to meet all requirements and have the merchant account set up and run. Let's see how the payment process unfolds. A traveler again uses a credit card to purchase a flight and a hotel stay. This time, the card information entered into the payment form goes directly to the payment gateway to be encrypted and forwarded to the merchant's acquiring bank, which in turn sends it to the card network, most often Visa or MasterCard. The card network connects the card issuing bank, which checks the data against the traveler's account. If the consumer has enough money, the confirmation goes in reverse, from the issuing bank to the card network, to the acquiring bank, to the payment gateway, to the OTA. Hallelujah! The transaction is authorized. The traveler receives a booking confirmation and a single credit card statement containing the total price of the services and the travel agency's name. The cost of the trip is blocked on the cardholder's spending limit. But the transaction is far from over. At this point, another decision has to be in place. How will you pay a supplier? Though the authorization happens almost instantly, it takes up to 3 days to move funds from the cardholder to the merchant account and finally to the agency's bank account, where they become available for financial operations. If there are any additional risks, the acquirer can hold money on the merchant account longer, for example, 15 days or even more. That's why a travel agency must think ahead to bridge 2 payment legs while the customer's money is blocked. Hotels give resellers more room to maneuver since they can make a payout closer to the stay date and even after it. But when it comes to flights, a window between a pay-in and a payout is very compressed.
There's a lot of decisions that need to be made on the spot. And one of the most important things is, okay, how do I fund this card? Is it going to be a prepaid card, a debit card, or a credit card with a credit line? Because it is very important for an online travel agency to make sure that there is sufficient cash available to pay the supplier. They need to have a very sophisticated treasury process to make sure that the incoming funds and the outgoing funds are in balance.
Merchants of record really have a lot on their plate at both payment stages. If you can't meet the requirements of the acquirers or don't have resources to manage everything in-house, does it mean you'd better stay on the agency model and give up trying to scale? Not really. There are providers who help newbies and small companies overcome the major pain points of becoming a merchant of record. Payment aggregators, also called payment facilitators, or PayFacs for short, save SMBs and startups the trouble of dealing with acquiring banks. Among well-known players in this field are PayPal, Adyen, Square, and Stripe. Aggregators maintain one master merchant account to literally aggregate transactions from multiple businesses. Only one merchant ID is exposed to the payment network, so a facilitator bears all financial risks and responsibilities. For businesses, the main advantage here is quick onboarding. You can start accepting payments in no time with all the needed technical infrastructure in place. On the dark side, shared use of one merchant account results in settlement delays and a higher vulnerability to fraud. To address these problems, aggregators limit the number of transactions and can freeze or even close your account if you sell too much, experience many chargebacks, or even for no obvious reason and without explanation. Conditions may be especially tough for travel agencies since they belong to high-risk businesses. OTAs and TMCs typically become subject to additional checks. Even if they are eventually approved, the aggregator can reverse its decision at any time. A way around this is to choose a prepaid method for the second leg as evidence of your ability to pay suppliers no matter what. Think about IATA EasyPay or Duffel Balance, which are B2B electronic wallets facilitating transactions with airlines. An agency tops the wallet up beforehand, thus guaranteeing that a carrier will get its money. This approach can potentially simplify the process of being vetted by an aggregator or acquirer.
And that gives the acquiring bank much more confidence that in case something happens to the travel agency, the supplier has already been paid or the money is safeguarded. And that means that the transactions are not as risky as they would be if the travel agency would get first paid and then they have to wait to see if in the end the supplier is paid.
Another approach is to consider a payment service provider specializing in high-risk merchant accounts or focusing on travel payments.
But what I would also say is that some interesting, change or developments that are also happening in the industry is that we are seeing new entrants from from a payment perspective, starting to address this market. So if you look at Stripe, for example, who's like a perfect one-stop shop hole for smaller merchants, we're starting to see similar model of payment providers that have an appetite to start tapping into the travel space.
An example is the WeTravel platform, which handles pay-ins and payouts for small travel businesses, or Duffel Payments, which covers the end-to-end payment process for flights. By the way, both providers run Stripe in the background. Let's see how Duffel Payments works. It collects money from travelers and uses it to pay an airline after subtracting markups added by a travel agency. So an OTA doesn't need to fund everything up front or run a merchant account. In this case, Duffel will be an acquirer, providing the tech infrastructure to accept credit cards and instant pay to airlines. With Duffel Payments, smaller agencies can try becoming merchants of record for carriers while continuing to operate on the agency model with other suppliers. This leads to the idea of mixed setups where both models are used. A familiar example of a mixed setup is when an OTA, operating on an agency model, decides to charge customers booking fees. To collect and process this additional payment, the reseller opens a low-risk merchant account and becomes a merchant of record for this portion of the total booking cost, but not for flights or accommodations. But let's again refer to the industry leaders, Booking Holding and Expedia Group. Today, both mix and match the two approaches. Platforms belonging to Booking Holding run over 50% of their operational flow on the merchant model. Expedia Group, in turn, handles 74% of its operations as a merchant of record, yet it keeps the rest of its reservations commission-based. So, there are many variations and no one-size-fits-all solutions, whether you're small or big. Payment strategies and policies are not etched in stone. They should be constantly considered, reviewed, and developed. Watch our other videos on payments and travel to learn more about actual methods, trends, and tools. We'll be back with more episodes soon.